So good afternoon, everyone. Thank you for being here today on this Saturday afternoon of March 14th, when we are all here to learn on corporate tax essentials. Before we move on to the topic, I would like to highlight the three things which are very valuable for us and which are priceless. Number one is our health. As our health is important, because if this body of ours is not healthy, then it not only becomes difficult for us, but also for difficult for people around us. And number two is time. Your time is important. You have given your few minutes here. You are here to learn, and we will see that it creates a great value for each one of you. And number three is relationships. As we continue with our journey of life, the relationships are most important because that is one thing where we may find it difficult to make a relationship if we don't see a benefit. But if we see that all uh, relationships is valuable for us, then it is unconditional. We don't see what we get from it. We are there to support each other. We are there when anyone needs us, as we are there for a friend. So I wish you very best in this journey of creating that impact which makes a significant difference to your life. Vinit, you can switch on your video. I'll just put you on the spotlight. Yeah. So today we have our speaker, our esteemed speaker, CA Vinit Gala. And I express my deep gratitude to Vinit for taking out time on this Saturday afternoon and for being here to share his knowledge with each one of us. I know Vinit from past few years, and I know Vinit as a tax expert. His expertise in the direct taxation, transfer pricing, international taxation is extremely valuable, and I have been seeing it from past many years. Vinit is currently working as a tax director in BDO UAE, and Vinit was one of the very few esteemed faculties which were empaneled by ICAI for UAE corporate tax course. And I have seen Vinit sharing his knowledge in different mediums so that he doesn't keep any his knowledge to himself but spreads it out. So thank you, Vinit. Thank you so much for being here with your more than decade of experience, with so much knowledge in such a short time will make a significant difference to the participants here. And with the emojis, I request all to please welcome Vinit with a big round of applause. You can use the emojis. Thank you. Thank you for being here. Thank you. And thank you, everyone. And Vinit, the screen is yours.
Yeah, so once again, good afternoon to each and everyone present over here. It's Saturday and Saturday afternoon. I'm sure everybody would be hungry for the lunch, but don't worry. I know I'm standing between you and your lunch. But yeah, give me some time. It's not going to be a technical session, but I'm here to just share the knowledge and what you should be doing when you start, your preparations for the second effective corporate tax compliances. So with this, I would just like to start first of all, appreciating Prabhdeep Singh Baweja for this initiative and thanking him. I know, he's a very kind person to me, and he has always been there for me, and he has always trusted me, when it comes to direct taxation. So, Prabhdeep sir, a big thank you to you for again providing me this opportunity and, allowing me to share my knowledge with the wider audience. Without further ado, I would just like to start my presentation. Just allow me to share my screen. And I hope now my screen is visible to each and every one of you.
Yes, Vinit.
As
Yeah, yes.
yeah, thank you. So as the topic goes, second year CT compliance essential. Now you must be wondering, what would be covered here, and it's almost, I would say, more than 3 years since the corporate tax was announced way back in January 2022, and then there was a public consultation draft which was put out somewhere in April 2022, and finally the decree was published in December 2022. So if I count from December 2022 till date, we have seen plethora of cabinet decisions, ministerial decisions, FTA decisions, guides, FAQs being published in the public domain, where a 63-page law was now running into thousands of pages. So when I say corporate tax law, I don't even mean the corporate tax decree alone, but everything together, and of course the practical experiences which you might have all gained when you have done the first year of compliances. Coming to setting the agenda for today, let me reiterate when I say essential, I am not getting into the technicalities of the law. I'm not here to discuss the provisions of the law with you, because I believe you are now more than expert to have the provisions in your mind, because you've already done the first year compliances. So the idea for today is not getting into the technicalities, but only discussing the essentials. What I plan to do is, first I'll discuss it, and then we can have an open forum of Q&A where we can have a general discussion, because I don't want to keep this session as a monologue, but it could be more of a dialogue and a discussion which would benefit the community at large. So starting first is the effect of new ministerial decisions. Of course, ministerial decisions have been coming, and more or less, these are actually the law, and I would say not clarification in nature. Only the guidance which comes from the FTA, where generally the public referred them to as a FTA guides. These guides are only for the interpretational and clarification purposes. But when I say ministerial decisions, along with cabinet decision and FTA decisions, these are actually the law which we need to follow. Many of the decisions are effective from the first day of the law getting effected, that is 1st June 2023. But there were some few ministerial decisions which were published later, and it has an effect from FY25 and onwards. To be very specific, it would be for financial years starting on or after 1st Jan 2025. And there are few, and let me just tell you which are those. Starting first is the ministerial decision around the participation exemption. Now, if you recollect, there was already a ministerial decision on participation exemption which lays on further criterias where you can have a participation exemption in place. One thing which was not clear is, if you do not have a 5% holding in of the company, but the cost of acquisition is more than AED 4 million, then what happens to the other conditions? And when I say other conditions, I refer to as 5% entitlement condition. So earlier, if I see a condition at a very broader level, it says 5% of the holding, along with 5% of the entitled to the net profits, 5% to the voting rights, 5% to the residual liquidation proceeds, and so on and so forth. But if you see the law, or I would say the relevant clause of the participation exemption in the decree law, I believe it is article number 23. There was a last clause which is written, again, a further guidance can be provided and a further decision can be made on these aspects. And the first decision which came out did provide further guidance, or I would say further regulations around the participation exemption. But one thing which was still not clear is, if I apply the minimum threshold of AD 400 million as a cost of acquisition, then what happens to the 5% entitlement test? Whether I still need to fulfill those tests, even though I only replace the 5% holding test. But what about the other 5% criteria? So FY25 or 24 rather, it was unclear, though the clarity was given in some of the guides where the flow chart was given. It did mention that the 5% entitlement test still needs to be followed. But in some cases, it might so happen that because of the cost of acquisition of 4 million, some other conditions may not be satisfied at all, and in that case the ambiguity was there. The government duly recognized that ambiguity and it came out with a further decision, but unfortunately, it has been made applicable for financial years starting from 1st January 2025 and onwards. So now, at least as far as FY25 is concerned, this aspect is clear that if the minimum threshold of 4 million acquisition cost is applied, then the 5% entitlement test is also automatically satisfied. But yeah, what happens to FY24? Unfortunately, there is no further clarity on FY24's position. People have taken their individual positions on that, and it continues from there. If your stakes are too high, and if you still believe that there could be an exposure in place, you may go for a private clarification, or somebody may also come up with a position that the intention was always to replace all the 5% criteria, and that's how ministry has made it clear by way of a separate decision. So very first thing, when you go for FY25 compliances or FY25 computations for provisioning purposes, do keep this decision in mind. And as I say, this decision not only caters to participation exemption, but there are few provisions which also deal with foreign permanent establishment exemptions. So please do keep it in mind. Though the essence of this decision is more focused on participation exemption conditions, but there are few clauses, or I would say few articles in the relevant decision which also caters to foreign permanent establishment exemptions. Moving to the next ministerial decision, which again becomes effective for financial year starting on or after 1st June 2025. And this is around tax group and financial statements. Talking about tax group, when you have a tax group, there were questions, which financial statements to be referred. Can I simply refer to my consolidated financial statements, or do I need to prepare a special purpose combination financial statements for my tax group? Though, if you add a logic to that question, the answer was very clear that special purpose consolidation, or I would say a combination, was always a requirement, because the way law is worded as far as the relevant decree article is concerned, as well as the provisions of the earlier decisions was concerned. But yes, there was no clarity on what kind of guidance would be there, and special treatments for special items would be available. Now it has been made clear by way of a ministerial decision, which again gets effect from FY25 and onwards. It is very clear special purpose financial statements has to be prepared for a tax group, and a relevant guidance is also in place by way of a FTA decision number 7 of 2025. So that was the second point as far as the new ministerial decisions are concerned. Third, very important and a very welcome step from the ministry, depreciation and on the fair valued investment property. So earlier, if your investment property is fair valued in the books of accounts, you did not get a benefit of depreciation, because the value in your books was anyways above the original cost. And there was no specific provision which allows you a depreciation on the actual cost incurred for buying that investment property. Ministry recognizes this fact, and it comes out with the decision, but it has been made effective again from FY24, 25 and onwards. So when you prepare your provisioning, the computation for the provisioning purposes as well as the tax return, and in case your balance sheet has a investment property which has been fair valued, in many cases it will be so, because when you follow IFRS, it is the case in majority of the cases, you are now allowed to claim a depreciation on that property. Of course, depreciation does not come on the fair valued figure, but there are the limitation rules around it. The most important part is the amount of depreciation is nothing but 4% of the original cost or tax written down value, whichever is lower. As I mentioned, I would not be getting into the technicalities, but yes, the fundamentally the position is you get the advantage of depreciation on the fair valued investment property. Important point to remember, this is again on election basis. So if you feel that this is not going to give you any advantage going further, then you may not opt for it. So opting or not opting for it is left up to you, but whichever decision you take, then it will be irrevocable. So depending upon the facts and circumstances and the number of properties held and what are you going to do with those properties, you may elect or not elect to take the advantage of this ministerial decision. Last, very important, the pillar 2. Of course, pillar 2 provisions do not apply to all the taxpayers, or I would say it only applies to the company which is part of the multinational enterprise group having consolidated turnover more than euro 750 million in 2 out of previous 4 years presiding the financial year concerned. So if you're talking about FY25, so you need to see the consolidated revenue threshold for 24, 23, 22, 21. And from the 21 to 24, if in either of the 2 year, from 2 out of the 4 years, if your threshold is getting crossed, then you are subjected to complex pillar 2 rules, which might ultimately take the tax provisioning number from 9% up to 15%. I am not saying 15%, but I'm using the word up to 15%. As I mentioned, these rules are very complex in nature. There are many safe harbor provisions also embedded in the Pillar 2 rules, along with the substance-based inclusion rules. So if your entity is part of this M&E group, which is in scope of the Pillar 2 rules, then I would suggest please go ahead and do an assessment, at least at your individual level, at UAE level, or you may do it at your HQ level and at least find out whether you are getting affected by this rule, and if yes, whether any safe harbor is available for you or no. If nothing, no safe harbor is available, no substance-based exclusion rules are applicable in your case, or I would say it is not helping you in your case, definitely your provisioning number could go up to as high as 15%. So this slide is the most important when I say essentials, because these are the new decisions, or I would say new regulations which becomes applicable when you do a second year of compliances. Number one, number two, number three may apply in more cases. I would say, I'm not saying majority of the cases, but I would say more cases. And pillar two, definitely, if not more, it could apply in limited number of cases. So depending upon your company, your business, wherever you are, either you're an owner or you're working as a finance professional or a tax professional or a consultant, please keep these things in mind, bare minimum. With this, let us move to next topic, which would be a lighter topic, the transition provisions. Now we know what are transition provisions. Ideally, it applies only to a qualifying immovable property, qualifying intangible assets, qualifying financial assets and liabilities. Again, let me reiterate, I'm not getting into the nitty gritty of the provisions. I'm here to tell you what you should be doing in year two as far as these transition provisions are concerned. So if you see on the right hand side of the screen where I've mentioned the key considerations. So let's discuss these considerations one by one. First, we need to review the election and the disclosures which you have made in the first tax return, because that would be the starting point now. Had this discussion been a year earlier, before your first compliances, I would have told, make a decision whether you want to go it or you don't want to go it. Now we are at a point in time where you have already made a decision whether you are in or you're out. If you're out, anyways, this slide is not applicable to you. But yeah, once you're in, definitely you need to see the disclosures which you have made in the first tax return. When I say review, of course, review in terms of whether the disclosures are right or wrong. And if they are right, definitely step number two will come in place, where I would say review the corporate tax relief calculations for the assets which you have disposed of in FY25, because these are relief provisions. And if relief is not taken correctly, it invites trouble in terms of additional tax liability as well as interest and penalties. Calculation, I would not say it is complex, but I would say it is not easy as well. Definitely, you need to review the computation in detail and also ensure if you have gone for the market value approach, your valuation reports are now in place. First year of compliances, in my practical experiences, there were last minute rushes as well as as far as real estate developers are concerned. There was a public clarification in place which says now we are going to give you a benefit for the real estate property development units as well. So last moment, many people, many consultants, many tax professionals were running around, and they got the valuation report in place. But there was not enough time in hand to review the calculations and disclosures in time. Having said that, again, if you have lost the ship, don't worry, you still have time. Review the positions. If something has to be corrected, do a voluntary disclosure. And yes, your second year compliances will definitely fall in place. Last but not the least, please ensure appropriate data entry in the tax return. I would say tax return is not static, it is dynamic, and I'm very much sure there would be some changes made in the second year tax return format. Again, not for the not for the sake of making the changes, but yes, it is like everybody is learning together. It's a journey which we all have to travel together, be it tax authority or be it a taxpayer. Definitely, some additional points would be there. Some corrections would have been made in the form. So please ensure appropriate data entry is now available in your second year tax compliances, and also review the first year disclosures which have been made. And if there is some error, please correct it. You still have an opportunity to correct it. With this, I end up the essentials for the transition provisions. Let's move ahead and talk about the provisions around the realization base of taxation. When I say realization based taxation, it is nothing but in a very simple terms, and everybody definitely now would be aware that there are provisions in place wherein, in case something is unrealized in your P&L and balance sheet, you may not offer that unrealized item to taxation. In a very very simple terms, I would say you move away ahead, or I would say you move ahead away from your regular accrual principle. Let's take an example of fair value in investment property. You move away from that principle and you only offer the taxation on the profits which you have actually realized. When you see the law, of course, there are two options given. One option number one is on all the fair value or impairment items, and option number two is on all the items which are capital in nature. I'm not getting into the nitty gritty or technicalities of the provision, but yes, I'm here to discuss what are the essentials which you need to consider when you're filing the second year tax return. The very first thing, again, the way we discussed in the transition provisions, review what kind of elections have you made. And yes, if you have made an election, then this becomes more relevant. And why I'm saying more relevant in transition, transition provision only gives you relief. It does not have a domino effect on year to year basis. It will only have effect now when you sell the asset. But in case of this provision which you have opted for, it will have a domino effect on every year. So as far as year number two is concerned, the second bullet point of key consideration is very much important. I say review or create asset-wise register to take the inclusions and exclusions for the corporate tax purposes. Now take a simple example. Let's take an example of a fair valued property in your balance sheet, and you have said, okay, I'll opt for a realization-based taxation, and you have gone under the option number one, and you have made an election in the first tax return. And there is a possibility that you might have excluded the revalued gain in year one itself, and you might have created some kind of deferred tax adjustments for that revalued item. Now, this revalued item again has an effect in year number two. There could be two possibilities, or I would say rather three possibilities. The value could have gone up, the value could have gone down, or you might have disposed the asset at all. Now, all the three items or all the three aspects which I discussed will definitely have an effect on the computation as well as your deferred tax computation. Here, I'm just taking a simple example of one property being fair valued. But imagine in your case, your balance sheet has n number of properties, or n number of items which are fair valued, and continuous fair value goes up, goes down. In some cases, it goes up, in some cases, it goes down, some cases, you have disposed of. So rather than waiting for the end last moment, wherein that you start preparing for the tax returns in month of August or September in majority of the cases, I would say please go ahead and have the asset wise register in place so that there's a clarity for each and every asset which you have chosen to offer to taxation for a realized based items. In case you do not do it, I'm assuring you Year two will still be okay. Year three might still be okay. Year four, year five, it will be a mess. And let's be honest to each other. We know people change jobs. Definitely, if you go out and if you take anyone else's handover, and if things are messy around, you will have a good time. And simultaneously, you also need to be fair for a successor who would be in your place. So this is a very important point. I am just stressing too much on that. Please have the hygiene measures in place. At least prepare the registers and keep it ready so that you do not have trouble later point of views. And last point, again, it will definitely have a deferred tax impact. If you have registers in place which are very strong from a control perspective, your deferred tax calculation will be very easy, and you will always have a very good time when it comes to finalization of the financial statements as well as your preparation of the tax returns. So from this slide, only important takeaway I would say is, if you have opted for the election, or rather if you have made an election for these kind of relief provisions, that's fine, but definitely have the registers, asset-wise registers in place, so that the tracking becomes more simple and calculation becomes more simple. With this, let's move on to another topic. Tax allowance, or I would say tax disallowances. These are more of a hygiene measures, I would say. I would say these are typically focusing to the year-end provisions. Generally, for my clients, also I have more focus on these items rather than those standard disallowances of entertainment, fines, penalties, etc. But these are the provisions where the subjectivity comes in place, and this is very much crucial as far as your closing of the financial statement is concerned. Number one, IFRS compliance. When you apply IFRS, definitely there are some provisions, where the calculations are made. One of the example which I've taken is the expected credit loss provisions. The allowability or non-allowability depends on how good your documentation is maintained, and of course, auditor certificate is important over there. Auditor will certify based on the calculation which you give them with your own analysis, or you may have your own IFRS consultant in place. But please do keep backup of these provisioning numbers so that you do not have problems in future. Second, a bit complex than number one, is expense related to provisions. Now we always have a habit, or I would say, not, let's not call it as a habit, but let's call it a legacy problem. In a large organization, this problem is very common. Invoices come in late. Imagine a situation, you're sitting in month of January and you're still receiving the invoices for November and December, but you have a cutoff date and you need to close your books of accounts. There are going to be cases where invoices are going to come in late, or might be invoices have already come in, but it is lying with the relevant department, and that department has not shared with the accounting department, and you forget to book an entry for that invoice. So this is a very simple example. So what you people tend to do is, they accrue the expenses based on some kind of calculation. Usually they have a buffer in place wherein they do the accruals for any kind of expenses which they foresee are belonging to a particular year, but invoices have not been received. So be very mindful when you do an accrual based on some kind of estimation. I'm not saying that this is always questioned, because first of all your auditors will have a basis and only then certify your financial statements. But audit principles are always based on materiality principles. Unfortunately, tax does not go on materiality principle. There's no materiality in concerned in corporate tax law. Even 1 dirham is material as far as corporate tax law is concerned. So there could be a possibility, in case your cases are picked up for audit, they will ask for how are their accrual. First of all, they'll say what kind of accruals you have made and what is the basis of making an accrual. If you do not have any basis of making an accrual, definitely take it in my view, you will be questioned, and some discomfort will be there as far as the provisionings are concerned. Last, ad hoc provisions. These ad hoc provisions are definitely not allowed for the corporate tax purposes. If you do not have any basis, please avoid doing any kind of ad hoc provisions. So key consideration as far as provisioning is concerned, definitely please test your cutoff procedures. If you do not have procedures in place, have some in place. Definitely, it would help you in the long run. And second, ensure sufficient documentations are there for all kind of provisions which you're making. It should not happen that something was contingent where only a disclosure was required, but you have made a provision, and auditor has certified this. Corporate tax law is much ahead of your financial statements. Tax authorities definitely have the power and the authority to question your audited financial statements. So don't be under assumption that if your financial statements are audited by some auditor, then you have done it everything. It's clearly a no. Let's move ahead with another topic. Some of the important areas. I would not spend much time on this. The nexus rule. Please be sure that the common cost is allocated appropriately with appropriate allocation keys. In many cases, I have seen common costs are not allocated itself, or whenever they are allocated, the allocation key is not properly documented from justification standpoint. And second important, there could be some assets which are ready to use, but they are not generating revenues. So it's just like putting an asset, but the commercial production has not yet started, or something on that lines. Or you have bought the asset, but you have not put to use those assets, even though it might not be generating the revenue, but you have not put to use those assets. So in this cases, do have a consultation whether to take the depreciation allowance or not to take. These kind of examples which I'm giving are not there clearly written in the law. It is always based on the application of the general principles of the corporate tax law provisions. And thus, I have felt it important to discuss in this session. So number one, common cost allocation. Second, assets which are ready to use but are not generating any revenues, or you have just bought and you have not put to use. I cumulatively call it as a nexus rule. Second, entertainment expenses. Here, I would just spend some time. Definitely, now people know what is allowed, what is not allowed, and 50%. The rule is always there. But the more important point is the marketing expenses, and there's a very thin line of differentiation when I say entertainment and marketing. So please have a proper documentation in place where you are saying certain expenses for the business development, and it is not pure entertainment in nature. And second important point is the contractual obligation. It could so happen that you have contracted with your supplier or a vendor, and you have a clause in the agreement itself that you would be providing some kind of food, some kind of accommodation, or some kind of transport facility for your vendor or a supplier, as part of the contract. So definitely these are not entertainment in nature, but these are part of a regular services or regular contract. So it may not be termed as an entertainment. So in case you still have such model in mind, but you have not documented in any contracts, please go ahead and document it at least, so that you're covered from a risk perspective. Third, some other areas, very common, I would say, in UAE, heavy cash expenditures. Unfortunately or fortunately, there is no provision in the law which restricts any expenditure where it is made in cash and it is above certain threshold. So that is not being kept. But definitely, if you're very heavy on the cash expenses, do keep supportings in hand, and these supportings should be very much robust, because this is the area where a tax officer can question you very easily, and these are very prone to some kind of mischief over there. I'm not saying this would be illegitimate expenses, but definitely the questioning can be there when it comes to heavy cash expenses. And last but not the least, expenses not having proper invoices or KYC documents. Do keep in mind the AML provision in UAE is very strong. If you are making any payment, receiving any payment, and if you do not have any supporting for that, you may end up in very wrong books of the tax authorities. So if you're making any payments, do have a justification why you're making a payment. And if you're receiving any payment, definitely do have a justification. Otherwise, if you've received maybe, for example, 1 million, but you do not have any answer, and you have just treated it as a random, a loan in your balance sheet, definitely tax authorities might have a right to question the source of these funds. And if the proper source of these funds is not disclosed, they may treat it as a normal revenue and tax those receipts which are not justified. So these are some key areas where the law is not put up in a very black and white, but yeah, these are some implications which definitely come as an application of the general principles of the law. So you need to take in mind, especially the business models in UAE is concerned. Moving to next topic, system related changes. I'll just spend 5 minutes on this because this is a generic in nature. Definitely, if you have not done any system changes, this is a slide which is more relevant for you. You can still do it from year two onwards or year three onwards, because again, this is again, when I say law is not mandating it in black and white, but this is again coming from the application and more of a hygiene perspective. So if I say red flagging of the ledgers, when there are specific disallowances, do flag it in the ledger itself, so that on the click of the button you know what kind of expenses are allowed, what kind of expenses are not allowed. And shareholder current account transaction. Now this is again a very important area, and I would like to spend 2 minutes on this. In UAE, in majority of the balance sheet, which are individual ownership is concerned, or a local group is concerned, we see this a very beautiful account called shareholder current account, because people do not tend to change the share capital again and again. But if there's an infusion, or if they want to take the funds out, they use the help of this account. So be very careful for the funds coming in and the funds going on, because definitely it would be a transaction with a connected person. So if you are not having any justification for any transaction or money coming in or money going out, definitely you should red flag it and have a consultation around it. Second point, separate GLs. This is again a very common, more important from a transfer pricing perspective and VAT law perspective as well. If all the transactions are jumped up, which is a reimbursement transaction or disbursement transaction, I would recommend now start having a separate ledgers around what you treated as a reimbursement and what you treated as a disbursement. Some additional record keeping for grandfathered loans. Definitely, we have a relief provision which does not take into consideration the interest cost on historic liability for the general interest limitation rules. So, if you have taken the benefit of such provisions, please do have a separate folder kept on your drive, that these are the liabilities and these are the agreements, so that any case where your audit is picked up in year 4 or year 5, for year number 1 or year number 2, you are ready, because FTA will give you only 5 days to respond. Maximum they may extend it by another 5 days or 15 days for you to give the documentation in place. And yes, for carry forward of interest and interest credit, any kind of adjustments, I just spoke about having a separate registers for the assets subject to realization elections. Please have those in place so that your life is simple going forward. Next, related party transaction. I'll just spend 2 minutes. Mapping of the related party transaction becomes more important. CT law has its own definition. IFRS has its own definition. It could be a case that a particular party is a related party as per IFRS, but you may take a different position for a corporate tax law perspective. If you are taking a different position, definitely please have a justification in mind and keep a internal memo in hand that why you have not included it as a related party for corporate tax purposes. Second point is more again to do with the modeling, where you are a limited risk distributor or a full-fledged distributor, and so on and so forth for manufacturing or a service sector businesses. Coming to connected person, this topic still remains debatable. Who should I call it a connected person? Who should I not call it a connected person? If you have not taken a formal consultation, definitely I would recommend go ahead and take it and have the justification documented. And once it is concluded that particular party is a connected person, arm's length criteria or market value criteria comes in. So you need to have a benchmarking in place. Last point, number C, some kind of implementation area. If you've not done a benchmarking yet, again, please go ahead and do it for year number 2 if you've not done it for year number 1. Ideally, you should do it for year number 1 as well. There are cases where you can still do it even today when we are speaking. And last is nothing but please review the shareholder current account in a very strategic manner, because it will have some kind of funding transaction, it will have some kind of reimbursement transaction, it will have some kind of dividend transaction. So this kind of account, in my practical experience, will be more in focus down the years. Last slide, and then I would just leave the discussion open for everybody. What you should be doing, and the most important slide of this discussion. First is settling the timelines. Please go ahead and finalize your accounts as soon as possible. Last year, we have seen the audits getting dragged till the last day of filing. Even 30th September, we had seen audit reports coming in from the auditors. I know there could be a blame game. You are not ready, auditor is not ready, you have not done your work, they have not done their work. I would say it is again a joint initiative. Please go ahead, close the accounts, get the audit done probably in the month of June, July, and don't wait for September to come in. Second point, your auditors will definitely be asking you the accounting, I would say the CT provisioning and the deferred tax numbers or deferred tax provision numbers, for which again you need to be ready with the computations. If you're doing it internally, well and good. But if you're taking the help of the consultants, please again be very much proactive and get it done as soon as possible, because without this, your audit will not get finalized. Pillar 2 provisions, I've specifically made it in red. This kind of area again will be a very much new area as far as FY25 is concerned, because it is the first year for Pillar 2 provisioning. So if you're yet to do any kind of assessment or any kind of computation, please start as soon as possible, because the provisions are a bit complex, and it might take some time to conclude on the provisioning number. Until and unless these provisioning numbers are not finalized, your auditor will not sign your financial statements. Third, do a hygiene check. If you are a free zone person, please ensure all the conditions are still satisfied, and everything remains the same as year number one. And again, more important, please do visit your Imara tax account, and please do check if everything is updated in the tax person profile. If not, go ahead and do it. And if there are some changes which needs to be updated, there is a timeline of only 20 to 25 business days. If you're not doing it, there is penalty waiting for you. Point number 4, transfer pricing. Please update the benchmarkings which you have already done in year number 1. And if you have not done anything, please go ahead and do it. And yes, updation of the local file and master file depending upon the facts of the case. But yes, updating the benchmarking is more important. The law does not mandate you to do a fresh benchmarking every year. It only mandates you to do fresh benchmarking every third year. But yes, the financial update is required every year. So please go ahead and start the procedures as soon as possible. Last but definitely not least, have the provisioning working in place, have the basis file in place, and also the asset registers in place. Thank you very much. That was it from my side. I hope this was some kind of value addition to you, so that you are prepared. And again, it was not a technical discussion, so I did not get into the technicalities for it. If you have any queries, feel free to reach out to me. I'm available. Don't feel that I'll not answer your questions unless and until you have an engagement with me. Feel free to reach out. I'm always there for an open discussion.
Thank you. Thank you, Vinit. I request uh, anyone who has a question to please unmute yourself and then ask. Yeah, so I don't see anyone. I request anyone. Sahil, you have any question?
Yeah, I just want to check with Vinny. If we filing the return, there are two questions coming. One is whether you are opting out from the regime, and second question is coming whether you satisfy all the conditions. So, do you think is there any logic to give both the questions separately?
You're talking about a free zone?
Yeah, exactly.
Yeah, so definitely, because the conditions are to be satisfied for each and every year. So even if for year one you have satisfied everything, not necessary that you will satisfied for year two as well. Or for some reason you want to come out of the free zone provisions because you're subjected to pillar two. So to have a I would say easy going on the at least a tax return format, wherein you are not supposed to have more disclosure if you're not opting for the free zone relief. then you will opt out in year 2, and then you remain out for next 5 years as well. And that's the only logic I see.
Got it. And one more question. Suppose at the time of deferred tax calculation, suppose I'm availing the transition provisions, okay, and I'm going to make the deferred tax asset as per IS 12. So, as per which method should I calculate the deferred tax asset or liability, whether as per the valuation method or the time apportionment method?
Sahil, to be very honest, if you're applying a transition provisions, I do not see any deferred tax coming in play, because this would be treated as permanent, I would say permanent differences. The only way where deferred tax impact might come in is where you're doing a consolidation. Uh, Again, when I say consolidation, again, I do not personally foresee any kind of temporary differences when you apply the transition provisions, unless there are some specific items coming in. So, to answer your question, should there be any kind of temporary difference which arises, which gives rise to the deferred taxes, then you have to take your internal positions, whether you go with the market value or time apportionment method. But in my practical experiences, this will not give to any kind of temporary difference.
Okay. Thank you, Vinit.
Sure. Thank you.
Yeah, so anyone else has any question? Can you please unmute or raise your hand? Yeah, thank you. Thank you so much, Vinit. Now Bindu is there.
Yeah.
Yes, Bindu,
Hi,
please.
Vinit.
Yeah. Hi.
The
Tell
session
me.
was very informative, actually. Thank you for the that's a good presentation. I have a question relating to the aggregation of financial statements you have mentioned initially.
Okay.
So last year that report was prepared based on the normal consolidation provision as per IFRS 10. So last year means 24. So
FY24. Yeah.
25, yeah, there is no change. But do you think, or what is your intake, whether we need to restate the financials for the previous year also based on the aggregation principle, or just we can add it in other matter, or emphasis that previous year financials are based on IFRS 10 and the current year financials are prepared on aggregation basis? What is your intake on
Okay.
that?
Yeah. So first, let's talk about FY24. When you said you have done it based on the consolidated financial statements. In this case, if there are few entities which are not grouped in a tax group, then definitely there was a need to have a separate consolidation, I would say special purpose consolidation in place. Having said that, let me assume that there were only three entities in your consolidated financial statements, and all the three entities are grouped under the tax group provisions. Then the question arises, do you have any kind of special consolidated provisions being applied as per IFRS which are not recognized as per the taxation law? A very simple example would be a goodwill which may come out of a business combination transaction. I'm just taking an example. So if you have not removed the effect of that, then definitely your 24 workings have to be changed. And if necessary, your tax return of 24 also has to be amended. Now, let's take an example where whatever was consolidated, there were no specific adjustments to be made. So your special purpose consolidation would have given you the same result what your consolidated financial is giving. Then I would say it may not be required to change anything from FY24 perspective. But now let's come to FY25, where we have a specific decision where we need to follow the specific rule of the law. So when you follow specific rule of the law for 25, there would be a comparative present for FY24 as well. This is how your financial statements are usually disclosed. You disclose 2 years at least in the financial statements. Then automatically whatever changes are there would be reflected in the columnar, which would be a comparative figure. So there you may still go ahead and do it only for 25. But if you feel, or I would say it is evident that because of the special purpose framework which is there, and 24 figures are also getting affected, then you may have to restate for 24 and also file a voluntary disclosure for 24.
You mean to say for in the particular example, last year there was a acquisition, the subsidiary was secured in last year, and there was some capital reserve adjustment because of common control.
Yeah.
That is the only difference there will be in the financials for 24 comparing to 25. So still
Okay.
you suggest to restate the financial year for the previous year, or it is not required because there is no
I
impact tax.
Yeah, definitely. There's no impact on the tax liability, as you mentioned in your example, because everything would be a balance sheet adjustments. But I would still recommend you restate it and keep it ready, because FY24 again there was many debates were going on with whomsoever you were working, and as a consulting side, we have always suggested to have a special consolidation in place. So if you did not have, then have it here in this year, and you restate for 24 as well. That would be a recommendatory, a recommendation from my side.
Okay, thank you. Can I ask one more question? It is relating to investment property. So last
Okay.
year, that investment property realization basis is not opted. But is there
Hmm.
any chance that we can do a voluntary disclosure this time to opt for the realization, or it is gone for 5 years now?
Yeah. So now, again, this is again debatable, I would say. If you want to change the year one position, practically, I would say we will have to check how it is happening. Now, a few months ago, I would just take a practical scenario without naming any person or any client. There was no clarity on the free zone aspects, and people had taken a conservative view, and they went ahead and then they paid the taxes also. But now, since the clarity is now available, they want to change the position, and we first went and checked whether the return form is allowing us to do a VD and change the elections. Initially, it was not allowing, but I believe recently they have made some changes as far as free zone is concerned, and they are allowing you to change the position. So now coming to your questions on the other elections, you may go and practically check if they are allowing you to do a VD and change the position. If yes, you are welcome to do it. If no, then yes, you will have to make a special application to FTA whenever the mechanism opens up and justify your reason of changing the position. But if your question is still arising only because of the new ministerial decision which has come up for the fair valued investment property, there is a provision in the law itself which allows you to elect or not elect the same from FY25 and onwards.
Thank you. Thank you so much.
Thank you,
Thank
thank
you.
you, Bindu. Yeah, Sahil, can you please unmute and go ahead?
Yeah.
Yeah.
Vinit, I have one more question. For the books closer, people are just making the provision 15% on a pillar two. So, do you think we have to do the exact calculation for the top up tax, or we can just close our books for 15%? Later on, we can calculate the top up tax. Yeah.
This is more of a audit question and more concerning with the auditor who is signing your financial statements. If he is comfortable with this approach, then you may do so. If he is not or she is not, then definitely you need to do the calculations as per the proper provisioning. Because what in my practical experiences, auditors are calling for the definite provisioning numbers because they need to check the materiality and then comment on it. So just to answer your question in short, it is up to the auditor how they are comfortable with either of the approach. For taxation purposes, anyways, you have to clear the liability with the actual calculation.
Okay. One more question. As per one MD 173, for investment properties recorded at the fair value, so in that situation, we can claim the depreciation, right? But
Okay.
as of now, there is no separate tab coming over the return in which we can claim the depreciation, right? As of now.
So I would say, if your question is where to claim, I would say wait for some time. And I did mention in the section, the form is not static; it is dynamic. They are making some changes again, and they are also learning with us. So some tabs and some schedules will be available over a period of time. And assumingly it is not available only till 30th September, there's a residual section where you can just claim an additional expense and move ahead.
Okay. Thank you so much, Vinit.
Okay,
Thank you.
thank you, Sahil.
Yes.
Abdul, can you please unmute yourself, Abdul, and ask your question? Yes. Abdul, can you unmute yourself? Yeah, okay, Abdul. Yeah,
Am I audible?
Yes, yes,
Yeah,
yes.
I
Yes,
can hear
hello.
you. Yeah.
Hello. I have one question regarding the depreciation. Suppose, let's say, I have one building completed in year 1995, and completion certificate from DM is coming in as in like year 1995, but it was not operations till 5 years. Let's say it came in the operations from 2000s. So, from which date do I have to calculate the depreciation?
So if see this is, I think we more technicalities are involved in this, but just to understand, anyways, you will be claiming depreciation for the tax year, that is FY24 and onwards, right? And in that
Yes.
period, your asset is already in use. So I'm not sure, whether this
No,
question
but
is relevant.
the years of the depreciation is giving the crucial. Like, suppose if I calculate from the 1995 itself, the WDV will.
Okay, okay. Now I understand. So I believe you're talking about the useful life of the building, so
Yes,
it will
useful
have
life
an
of,
impact.
yes.
Huh. So again, this would be more of a audit question, because here there are no specific guidances available on estimating the useful life of the building. If your justifications are right and your auditors are certified that okay, 30 years or 35 years and whatever would be the start year, you can do it as per IFRS.
Okay, okay, okay. Thank you.
Okay. Thank you, Abdul. Pradeep, you had one question. Would you like to unmute yourself and ask? Okay, I see one unmute, a Zoom user. Can you please go ahead?
So this is Shivang. So
Okay,
just one
thank you.
question was one confirmation. Let's suppose we have a building and we have done revaluation in the past year, and we have opted for the realization basis of accounting. Accordingly, all the depreciation has to be reversed up to the original cost as per the law.
Yeah.
Means year on, yeah.
Okay.
So
Mhm.
the original cost shall be considered when the it was originally purchased, or yeah, means any revaluations has to, yeah,
Yeah,
means it is
I get
quite
got your
common.
question.
Yeah, you might correct.
Yeah. So again, I would say there's no clear-cut black and
No
white
clear cut.
provision
Yeah.
in the law which says which would what would be the original cost. Again, taking a clue from the provisions, transition provisions, where it says a closing balance sheet becomes the opening balance sheet, and read with the guidance of the IFRS guide for the taxation purposes. It mentions there, your closing balances automatically becomes your opening balances. So you may take a position that the revalued figure as on 1st January 2024 is your original cost. But yes, I understand you have not spent anything and you are treating it as an original cost. There is a question mark on that, because you have not spent anything and you're claiming a depreciation on that. So many of them have taken their individual position and then they have filed a return. But again, there is no clear answer on that.
So just one point in the return guide, it was mentioned that the original cost should be as per the date when it was originally purchased. So there was
Hmm.
not, I can say clarity is there, but when you are doing the calculation practically, so it might create a means you can create a backlog. How can we do
No,
that?
so I understand that sentence is mentioned, but
Correct.
you can still go ahead and argue that that sentence is only valid for the newly acquired assets. And because the
Yeah.
law is general in nature, it is not that sentence is not categorically pointing on each and every kind of provision. It is just a general in nature, I would say. But yes, as I
Correct.
said, the things are still
Yes,
not clear as far as this aspect is concerned. You have to take a original position and go ahead. If you want to be more conservative, then you disregard your revaluation which has been done up to the first financial up to the first day of the first tax year.
and apart from that, sir, in a way, if we don't elect the even the realization basis of accounting, so even on the fair value, we are allowed the depreciation in a way. Let's suppose if we not
Hmm.
elect for the realization basis of accounting, so in a way, if we have done the revaluation of past assets, let's say its cost was 1 million and we have revalued up to 10 million.
Hmm.
So on the 10 million, the depreciation will be allowed. So it is
Yeah,
better.
so
Yeah, means
that's the
something like
reason I'm saying if you need to be conservative,
correct.
then
No problem.
you ignore the revaluation effect, or else you may still go ahead with the revalued figure, saying the transition provisions are there, which says closing balance becomes the opening balance.
Okay. Okay. Okay.
Thank
Thank you, sir. Thank you.
Thank you. Our scheduled time is over, but as Sahil, I will allow your last question and then we will close. Yeah,
Uh,
Sahil. Keep it shorter.
yeah, one more question. So, as per Article 23, there is a participation exemption.
Right.
In some of the cases, there's a impairment loss. So, in
Okay.
that case, I cannot claim the impairment loss because it cover under the participation exemption. So, I just want to
Right.
check it's a optional or it's a compulsory. I have to take the participation because in the case of loss, I cannot
Hmm.
deduct that loss. Right.
Of course, see, the provisions are not on election basis. It applies automatically for all the years. If the particular investment instrument is eligible for participant exemption, whether it is profit or loss, it applies both the ways. So your the impairment loss will anyways not be allowed in that case. So it is again a permanently out when you need to disallow it in your tax return, even though you have not opted for realization based taxation, since your instrument qualifies for participation exemption.
Got it. Thank you. Yeah.
Yeah.
Okay, so thank you so much, Vinit, for your insightful session, and you have answered so many queries. And anyone, all of you have Zoom, YouTube link. You can go back and check it. Big round of applause is already coming your way, Vinit. And is there anything, the last words you would like to share?
Okay, so last words are only very simple. I would say just take care of yourself. Follow the official channels of communication from the government side. Don't believe on any reels and any kind of WhatsApp information being circulated anywhere. Please follow the official channels and stay indoors as much as possible. Those are the last words I would say.
Anything on the corporate tax?
No, so I would say, life and death and taxes are now constant. You do not have a way out. You need to live with it. So live with it, but just to make your life simple, be proactive and don't keep things for the last moment. That's what, I would like to say.
Thank you. Thank you so much, Vinit. Always, your sessions are very insightful, and that's what made a big difference. I'm so glad that it helped so many here live, and there were many who were watching live on YouTube, and that would be available for many to benefit subsequently. So,
Yeah.
the CA Speakers Forum is for all the chartered accountants abroad, where we are here to help everyone become a speaker. So that's what the motive of it. And as we continue with the journey, we will do our best to make a difference. Thank you. Yes, Vinit.
One last point,
Yeah.
the views are totally personal views. It does not solicit or it does not convey or relay any message from any of the organizations which I've been working for. So please do not treat it whatever we have discussed as a position. This was only a general discussion and views are strictly personal.
Yes, so this is very important from my side also. This is one thing is only for knowledge sharing, for making everyone speaker, for transmitting the knowledge, for sharing the knowledge, what can be shared. So that's very important. And thank you, Vinit, for highlighting it. And have a great Saturday afternoon, each one of you. Take good care of yourself. See you soon again. Bye bye. Thank
Thank
you.
you. Bye.
Thank you, sir. Thank you.
Thank you.
Thank you.